Today we will be discussing on the very first chapter in regard with your second year syllabus, that is savings. Savings is a very important part in everyone's life in order to face the future. In this chapter, the objectives are initially it helps in understanding the concept of savings. Mainly we'll be discussing on the definition of savings, and then secondly we'll be learning about the various saving institutions. There are certain saving institutions which mainly helps us in saving the amount or whatever the properties that we earn in our day-to-day life. To begin with the introduction, savings are a means of providing for future wants. Everybody has desires, everybody has wants, and that will be fulfilled only with the savings. Savings can be defined as an abstinence from present consumption for the purpose of future consumption. So, here the term abstinence is where stopping oneself from having or doing what you enjoy. Usually, as I mentioned, we have so much of desires and wants. If we keep on expending things, whatever we are earning, what happens at the end of the day? We have nothing to spend. So, abstinence is where you are stopping yourself from whatever you desire so that that amount or that thing or that property or that material can be used for your future use. So, you are stopping yourself from something that you enjoy or something that you really like. For example, most of us like food, most of us like dresses. So if I am earning some minimum amount in a month, then I have to make sure that certain amount has to be saved. If I expend the entire amount for the clothing, then what will happen? I'm just expending it for my desires and not I'm not saving the amount. So here savings can be defined as an abstinence, that is you are stopping yourself from something that you enjoy from the present consumption so that you are saving it for the future for the purpose of future consumption. You can also give an example like the present pandemic situation where most of us are finding very difficult with the lack of money. Some of them have lost their job. Some of them have not are not prepared for the future. So in that instances, or if there's any natural calamities, if you have saved some amount or if you have saved your grains, like in the villages what they do, they try to save some grain so that it can be used in future seasons. So in that manner, I think savings really helps one to face the future consumption. It can also be given in the form of an equation: savings is equal to income minus expenditure. So savings is nothing but the income what you get minus the expenditure. How much you expend, the remaining amount from the income that you get can be considered as the savings. Savings is a certain proportion of income kept aside regularly for a secured future in productive form. Most of us do it at home, isn't it? So your father may be the bread earner or the mother may be the bread earner. In that case, what they do, mother try to save some amount keeping it in her kitchen boxes where some amount can be kept so that it can be used in the future days. So certain proportion of income is kept aside regularly for a secured future in a productive form. What is the need for savings? Why we have to save? Mainly, it helps in the period of physical inability during illness. None of us will be prepared what arises in the future. But then this savings definitely helps us to face the future. For instances, like if there's any physical inability or if there's any medical emergencies. So in that case, the saved amount or savings can be utilized. It also reduces the economic insecurity, especially in old age after retirement. Even old age people, I think most of the family members, if they are not prepared properly, or if they have not organized their life properly, what they do at the end, during their old age, they face it very difficult. because they might have expended the entire money or entire properties or whatever they have to their children or to their relatives. At the end of the days, what they do, they really face very difficult to face the reason they don't have money. Definitely in this present world, money is everything. For everything that you like or aspire, you have to expend in order to buy it. Then for future use, definitely for future you need some savings become a source of income. So it can be a source of income. For example, some of the amount that is cut off in the salary is provided in the form of PF, ESIs. So in that case, what happens in the future, it becomes a source of income. Or sometimes if you have invested on the properties of building home, it can come in the form of lease or rent too. So it depends like how you have planned your savings. Maintains a standard of living. Definitely there is no necessity that you can go and beg money from someone or you ask debt from someone. So it maintains your standard of living. Saving is good habit. I think from your childhood itself you have to start learning to save, just like how you have your piggy banks where you get your pocket monies and you try saving it. So in that format you have to have a habit of saving some money. Useful during an emergency, for instances like loss of jobs, accidents, natural calamities, loss of earning member or breadwinner. So if the entire family is dependent on one single person, if that person is no more, definitely the family will face the crisis, isn't it? So in that case, savings definitely helps at the time of emergencies. Useful for children's education, marriage, or other family expenditure. Mainly, it helps in education and also marriage and also other family expenditures. Useful for making big purchases like house, car, etc. All of a sudden, one night or one evening, one morning, you can't purchase house or car unless and until you have savings, because that requires a huge amount, isn't it? So in that case, it also helps in maintaining a little bit of your luxury life by purchasing a car or house when in need. So these are the needs for savings. In this chapter, as I've mentioned it in the objectives, we'll be discussing on various saving institutions. We'll be learning on various saving institutions, which is very, very important. You keeping it for yourselves, maybe at time you may just expand it, and at the end of the day you will not have even a single penny. In that case, if you are saving it in some institution, that institution will take care, and in turn you can also get it back in the form of profit. In that case, the first institution, so as we have here, as mentioned, the various saving institutions are bank, LIC, post office, chit fund. The very first institution we'll be discussing here is bank. A bank is a financial institution which does business by taking charge of people's money and letting them draw it back when they need it. Everybody have been to bank. Here, bank mainly what it does, it helps in protecting the money of the public or people. It lends the money when they are in need, and it also saves the money, the one which is deposited by the public. So here it does the business by taking charge of people's money and letting them draw it back when they need it. So, and also usually you can deposit your own money. At times, they also lend you loans or debts when required, which in turn can be returned to the bank in the form of installments. Under bank, like how exactly deposits can be made? There are different kinds of deposits. Here, the first deposit is the current account. Current account, here it is current account is operated by business section. Obviously, business people, they need more money to do their business. Mainly, this current account is used by business people and they require larger capital, isn't it? They need more money to form or to maintain their business. So it does not carry any interest. So usually you don't in turn the bank will be providing you some interest, but here in current account there is no any interest as such. Frequent deposits and withdrawals can be made. Why? Because business there will be profits and there will be losses, so as and when required they can deposit and they can withdraw. Current account, you can maintain a minimum deposit of rupees 5,000. So you have to maintain a minimum deposit of rupees 5,000 and there is no restrictions for deposits or withdrawals. In this current account, there is no restrictions as such, and then minimum balance has to be maintained. There are some other accounts where zero balance account where you need not maintain any minimum balance, but here in current account you have to maintain a minimum balance of rupees 5,000. If you don't maintain, then your account may get lapsed. Then bank makes small charges for every withdrawals or deposits that you make. It is so obvious because bank, in order to operate your account, obviously will charge some minimum amount for every withdrawals or every deposits that you make. Allows overdraft facilities to depositors too. So a draft will be provided every time that you deposit. So this is all about the current account. Mainly it is utilized by business people where larger capital is used and frequent deposits and withdrawals can be made, and minimum balance of rupees 5,000 has to be balanced. There is no any restrictions for withdrawals or deposits irrespective of how much ever time you want to withdraw or deposit, you can make it. So that is about the current account. Coming to the second one, that is the saving account. Here savings, mainly it concentrates on a family. So savings which are made by family and then small interest calculated. So here in the current account where you had a larger capital, but here in saving account you have a very small interest and which can be calculated for every 6 months, so if you are depositing some small amount, for every 6 months they'll calculate the interest and they will give you. So withdrawals are restricted and specified. Obviously, the reason is since the amount that is deposited is very minimum or it is in a small amount. So for that case, the withdrawals and deposits are restricted in case of the savings account. So longer the period of deposit, higher will be the interest. So in case of this savings account, if you keep it for longer period, definitely the interest will be more. And no passbook or check is issued. Sorry, under this savings account, withdrawals and deposits are very much specified and restricted, and it is mainly not required for the immediate use. Here, since it is restricted, you can't withdraw or deposit as and when required. So you definitely it is not helpful at the time of your emergency. So you can't use it immediately. And here you have to maintain a minimum balance of rupees 1,000 and a passbook will be issued. In the savings account, passbook will be issued, and then deposits can be made any time but interest calculated for every 3 to 6 months. So here, as I've told you, small amount will be saved for every 3 to 6 months, the interest will be calculated with the withdrawals limited for only one time. So only one time the withdrawals will be restricted. So here under the savings account, mainly it concentrates on the family where a small amount is deposited and the interest will be calculated for every 3 to 6 months. Deposits or withdrawals is restricted for only once, and a passbook will be issued in order to record the withdrawals and the deposits that are made. And the third one is the fixed deposit. The very name itself suggests, isn't it? It is fixed for a certain period of time where you cannot move it or can't withdraw any amount before the period of time that it has to be matured or get lapsed. So fixed deposit here, deposits of money for specified periods. For specified period of time, money is deposited and it earns more interest but depends on period of deposit. So obviously more amount is deposited here for a specific period, and the longer the period of deposition, the more interest you earn. Money not withdrawn before the lapse of stated period. So if you are withdrawing money before the lapse period, definitely they are not going to allow it. So you have to withdraw only until the maturity date appears. So money not withdrawn before the lapse of stated period. So term deposit schemes. So there are two terminologies under this fixed deposit, where there is term deposit scheme and then a special term deposit. What happens in term deposit scheme is there is a periodic pay of interest. At the time of opening this fixed deposit, you can mention whether you need a term deposit scheme or a special term deposit. Under this term deposit scheme, what they do is for a periodic time, they pay you the interest. Maybe for 3 months, maybe for 6 months, maybe for a year, they may pay you the interest. That is the term deposit scheme. And special term deposit is the second one, where you get interest only at the end of the stated period of maturity of your fixed deposit. That is the final interest altogether, not in the form of periodic pay, but here in the special term deposit, they give you the compound interest, where all interest are put together and given at last at the time of your account that is matured. So here it is like longer the period of deposit, higher will be the interest. So if you are getting a periodic pay, then definitely I don't think so the interest will be more, but you are keeping it for a longer period, the interest will be more. No passbook or check is issued in case of fixed deposit. In savings, uh, passbook is issued. In current account, passbook is issued, but in fixed account, no passbook is issued. But then what they do is there is a fixed deposit receipt that is issued instead. Instead of passbook, what they give you is the fixed deposit receipt. That is very important, FDR. That receipt has to be maintained. If you lose that receipt, definitely you cannot get back your money, or you have to undergo some other procedures in order to get back your money. So here you have a fixed deposit receipt which has to be produced at the time of the maturity of your account. So receipt is signed by the bank manager and has to be claimed at the time of maturity of your account, and you have to produce this receipt in order to get back your fixed deposit money. So this is about the fixed deposit. Then coming to the fourth one, that is the recurring deposit. Here again, the very name itself, recurring deposits a fixed amount every month for a period of time. So it is a kind of installments what you make. For a certain amount is fixed and you have to pay it every month. You have to pay it every month. Who cannot make larger deposits or lump sum. So here what happens, business people, they deposit more amount. And fixed deposit too, they try to invest more amount. Savings is a little amount where they try save in order to get a small interest. But here in the recurring amount, even here what they do is they cannot invest or they cannot deposit more or larger amount. In that case, they try installing or investing a very minimum amount every month. but opened with a small amount specified period. So what they do is they open with a very small amount for a specified period. So installments may be in the form of 12, 24, 36, 48, and 60, just the multiplication of the initial digit, and then it can go up to in that way. The example how it can be given, so deposits of rupees 100 per month. uh, if you are depositing, I'm giving you an example for the recurring deposit. If you are saving rupees 100 per month, if you are depositing rupees 100 per month, then for a year how much it will be? 1200. So after, so if it is a very small period, consider if it is for 5 years. If it is for 5 years, then 1200 into 5 years will be 6000. But if you are keeping it for 5 years, the extra interest that will be paid by the bank is 7,790. So 1,790 rupees will be your profit for paying the amount every month of rupees 100. Irrespective, it is not only 100, you can also pay 200, 300 based on your capacity. That is the recurring deposit, where minimum amount is paid every month, and after a small period of time the interest will be returned with the profit. So here mainly they concentrate on people who cannot deposit more amount, but they can deposit some small amount and also can fetch some profit through it. So it is mainly, or it is most suitable for person from low and middle income groups. Yes, as I told you, people who are into low financial status or middle income group can opt for this recurring deposit. Budget planning can be easily made by this kind of recurring deposits. They can plan out their budget in a very organized way. And even for this, a passbook is issued, an amount can be withdrawn only on the closure of recurring deposit account. So same thing, it applies even for the fixed deposit and here the recurring deposit. Only you can withdraw the amount at the time of closure of your recurring deposit. So in between you cannot withdraw it, but only by closing your recurring deposit you can withdraw the amount that you have deposited. So if withdrawal is early, then the rate of interest paid is lower by the bank. For instance, as I gave you the example, it for 5 years, if you are trying to withdraw the amount somewhere in between 3 years, obviously the interest will be reduced. So the more you keep as required or the time slotted, if you're keeping it for that period of time, then you will get the required interest. If you are withdrawing it in the early time, then what happens? The required interest won't be issued by the bank. So this is all about the kinds of deposits when we are discussing under the bank. So current account, saving account, fixed deposits and recurring deposits are the kind of deposit which mainly helps in saving our money under the institution of bank. The next saving institution we'll be discussing is LIC. The abbreviation is Life Insurance Corporation of India, a very known institution which has helped many people in times of need. So, life insurance as originally devised in order to provide financial protection for the dependents of the family of the individual. So, this institution mainly take care of the family or the person whoever are in need at the time of emergency, or especially at the time of financial crisis, or when they are left empty handed, or at the time of emergencies. This institution mainly comes and helps. Um, so it was devised to provide financial protection, and then and it is worldwide used, and it is the best method of savings, and provides an opportunity to think ahead of needs to come. So it is mainly helping you to be far-sighted, looking forward of whatever the requirement or the emergencies that may arise in the future. Keeping that in mind, I think you can start saving your money in this institution. So it mainly helps to think you or gives you an opportunity to think ahead of needs that arises in your future, and gets money at the untimely death. So if the entire family is dependent on one person who's the head of the family or the breadwinner of the family, in that situation where they are not at all prepared to face the future, in that condition, that is untimely death, nobody is prepared. So in that condition, so this institution mainly helps in providing you the money, and also maybe at the time of daughter's wedding or in case of educations or other future needs it can be used. So the insurances that you make these insurances can be used at these situations like untimely death of the bread earner, or daughter's or son's wedding, or at the time of education or any other emergency future needs, it can be used. So less premium for longer period. So you can pay a minimum amount, requesting or the institution to pay for a longer period of time. And then life insurance is a contract between an individual called insured and the insurance company. Definitely, it is an insurance that you're going to build, and it is a contract between the insured person, the one who is going to pay the money, and with the insurance company. So money paid at specified time or stated interval, and takes return from whom the later agrees to pay, or death of the person. So here what happens is that the person who agrees to pay at the specified period of time, the money is returned at the time of death or when the insurance is matured, or also in the absence of that money, the person may had assigned another third person who is called as the beneficiary person. In that situation, the money will be given to the third party, and that third party is called as the beneficiary person, and he claims the benefit of that particular insurance which is provided by the institution. So that contract is called as the policy. So the contract between the insured person and the insurance company is called as the policy, and the periodic payment is called as the premium, and can be payable monthly, quarterly, halfly, yearly, or annually based on their availability, or based on how the money is available all throughout the year. Based on it, they'll calculate and they can pay it either monthly, quarterly, half yearly, or annually. It is a government owned corporation, so money remains very safe. So life insurance corporation is a government owned corporation, and you need not worry about the money where it may get lost or they can loot it, but then it is mainly governed by the government, so you can rest assured, you can remain safe that your money will also remain safe and it will be given back to you. So here a limited period life policy. So here uh, for short time or the time which is prescribed, it remains and then it gets matured. So limited period life policy are called as the endowment policy. So it remains for a very limited period. Example, I can give you an example for the endowment policy. Here education policy is considered as an endowment policy, which matures when the child is ready to enter the college. So once the schoolings are done, up to schoolings, the parents can save money under education endowment policy. Once schoolings are done and the child is ready to enter the college, so that education policy is matured and that money can be utilized for the higher studies or college studies of the child. So where parents are far-sighted in saving the money for the higher education of their daughter or their son. So it is widely accepted policy. Education endowment policy is widely accepted, and it provides income tax relief benefits. So this endowment policy, what it does, it provides the income tax free relief and gives you enough benefit by making these policies. So this is all about life insurance corporation, and which are the widely accepted policies here. It is whole life insurance or term insurance, ordinary insurance, Grihalakshmi, Jeevan Dara, Jeevan Raksha, Jeevan Shri. So these are some of the widely accepted policies by the public when they make a policy or when they make an agreement between the with the company. So there may be a question for 2 marks where you have to write a short note on LIC, or a 1 mark where you have to abbreviate on LIC, or there may be 2 mark question to arising where, where they can ask you to mention some of the widely accepted policies by LIC, or it can also be asked for 5 marks where you have to explain the each institutions which mainly helps in savings. Then you have to explain in detail about one particular institution. Previously we discussed bank and LIC, post office, chit funds, each you have to explain it in brief for 5 marks. So depending on the requirement of marks, you have to write an answer. So the next institution is the post office. So it's been a very oldest saving institution. These are one of the oldest saving institutions in the country, having been established over 150 years ago. So uh, you'll have an idea of how old this institution is. 150 years ago, post office savings were introduced before commercial banks opened their branches. So before bank existed, post office came into an existence in order to help to save money. So it is the oldest saving institution, and it is restricted in bigger uh, areas and found everywhere in smallest uh, lower income people. So it mainly concentrates on people who are having a minimum economic status or the lowest economic status. Usually people who are earning more or having a higher financial status will go and seek in case of bank. But your post office mainly concentrates on people who are financially low, in helping them to save the minimum amount. So opened with us, so less as rupees 25. So you can just open an account with a minimum amount of rupees 25, and withdrawals are restricted once in a week. So even here withdrawals are restricted once in a week, and then helps the lower and the middle income group in saving the money. And account can be opened with a less as rupees 25 rupees, and maximum amount which can be kept here is 1,25,000 only. You can't exceed more than this. So obviously people who are having a very low financial status, they can uh, go and seek of this post office. So the maximum amount that can be saved here is 1,25,000 only. So withdrawal restricted to only once in a week, and government has given them facilities of a cumulative time and recurring time. Even here in this post office, you can have the cumulative time and the recurring time. In cumulative time, what happens? Your fixed amount is paid into the post office saving banks per month for a period of 10 years, and accumulated principal and interest at the end. So for 10 years, you can just deposit the money, and then at the end you can claim your principal, interest. At the end you can have the lump sum amount. And then the recurring deposit, what happens? It takes for 5 years or even for the other period, so the extra 5 years. If you are planned for 5 years, and also you can continue for another 5 years, government gives them the advantage that savings and earnings totally exempted from income tax. So here, uh, even here, you are totally exempted from the income tax. You can just save money for the whole of 10 years, or you can bifurcate into 5 years for the first set and another 5 years for the second set, and start saving money. Cumulative is where you have the lump sum amount at the end provided with the interest. Your recurring deposit is where that amount can be bifurcated into two, and you can withdraw the or gain the interest of the money that you have saved, and totally it is exempted from the income tax. So this is about the post office. This is about the post office. So the next saving institution and the last saving institution mentioned as per your syllabus is the chit fund. Chit fund are very old and most popular method of savings and raising money for a long time. Even here, even before the bank existed, I think the post office mainly helped in saving money, and also even lesser without getting into any post office. I think even this is another method of saving money, which is considered as the chit fund, and where you can raise the money for a longer time, and they encourage people to save according to their capacities. So even here there is nothing like so much of amount has to be paid. In post office at least you have a minimum of rupees 25,000 that has to be paid. Here in chit fund even less, based on your capacity, maybe even a 10 rupees or 20 rupees or 25 rupees, based on your capacities you can save your money, and provides a ready means of getting a lump sum which can be utilized for some special purpose. So a very small amounts put together, and at last you can get the lump sum amount. So payment are an installment. So it may be same thing here. It may be weekly ones or monthly ones, but you have to make a payment in the form of installments. And chit funds have to be registered with the government when they call for public participation. So when there are more number of people, or when they are calling for the public participation, obviously these chit funds has to get registered with the government, because they are playing with the public. For that reason they have to definitely get registered with the government. And there are different kinds of chit funds. The first one is the lottery chit. Many of us would be aware. I don't know how many of you have seen the lottery chit, where many people have lost their financial status because just going behind this lottery chits, because one and many will be benefited among this, but even then some people are benefited and has helped their financial status. Their lottery chit, some people get together a number of acquaintees or friends who undertake to make periodic payments of the specified amount for a certain period. um, for example, say rupees 500 per month for a period of 12 or 24 months, total collections are made. So here, people who are aware, people who have the knowledge, so they and their relations or their friends, those people, they come together and they undertake and they make periodic payments of specified amount. Certain amount will be fixed for the specific period, for certain period. Say as it is mentioned in the example, like for example rupees 500 per month for a period of 12 or 24 months, total collections will be made. So maybe for a year or 2 year, the amount will be collected. And the promoter, the one who has initiated the group, the promoter gets the first month total collection. So maybe a group of 25 people or 30 people, if it is 500, then the 30 into 500, how much ever the amount that is got, that amount will be first taken by the promoter, which is considered as his commission. And then succeeding months, the name of persons contributing are written on pieces of paper, and one is picked out of the other, which has names of person who have not received the total amount of collection. So each person gets the money in turn. So what they do is, after once the commission is collected from the promoter, from next month onwards, they will write the names of the people who are contributing, and once it is picked up, and the amount that is collected will be given to that person. So each one, so it's not like repetition, each will be getting their turn. The one who has taken the amount will be exempted in the next lottery chit. So next is the auction chit. The second one is the auction chit here. It mainly depends on urgency and also the degree of competition. Like in that particular group, what is the need or what is the emergency or what is the urgency, and also it may depend upon the competition. their need. Based on that too, you can claim the amount that is saved. So monthly collection is put up for auction among the members. So monthly collection is put up, and one who bids the lowest amount offers the highest discount. So it's like if you are taking the money in the very earlier stage, then definitely you will be getting a very lower interest. But if you are waiting for some long time and then bidding for money, you will get the higher interest. Next month, the previous bid drops out from the auction, although he continues to contribute. So even here, once the person has claimed the money and has taken it, so the person will be dropped out and he will be continuing to contribute the money that he has taken, and in the next auction that name will not be included. Each month, the discount and amount saved is divided up among all the subscribing members. So each month, the interest and the amount saved will be divided among the members of that group, and last member gets the full amount. So the last one who remains patiently, so that person will be getting the full amount. That is about the auction chit. So this chapter is all about knowing the definition of the saying, savings and need for savings, and learning about the various saving institutions. So initially we learned about bank, secondly we learned about a life insurance corporation, and thirdly we learned about post office, and fourth is about chit fund. Thank you.